Today, we're diving into one of the wildest headlines to come out of the AI space recently. MiniMax, a company that's been getting a ton of buzz, just posted a massive loss. We're talking nearly $2 billion. So the question everyone's asking is this just the steep price you have to pay to build the next AI giant? Or is this a huge red flag that the bubble's about to pop? Let's get into it.
I mean, just look at these numbers. On the surface, they look completely insane, right? $1 billion loss on less than $80 million in revenue. That means for every single dollar they make, they're losing over 23. In pretty much any other business, that would be a 5-alarm fire. But, in the world of high-growth AI, things aren't always what they seem. There's a much deeper story here.
So here's how we're going to break it all down. First, we're going to get to the truth behind that massive loss. Then, we'll find the real growth engine hiding under the hood. After that, we'll dig into their unique global strategy, figure out why it's considered such a rare stock, and then, finally, we'll put it all together for the investor's final verdict.
Okay, first things first, we have to tackle that headline-grabbing loss. We're going to need to peel back some layers of accounting here to see what's actually happening with the company's cash and its day-to-day operations.
And there it is, the number that's causing all the fuss, negative $1.87 billion. It's a scary number, for sure. And look, if this was a simple operational loss, money they actually burned on salaries and servers, this would be a disaster story. But, and this is the key, it's not.
So this is the concept you absolutely have to understand. It's called a paper loss. See, before MiniMax went public, they gave preferred shares to their early investors. And as the company's valuation went through the roof, which, by the way, is a good thing, the value of those shares also shot up. Well, accounting rules say you have to record that increase as a liability, a loss, even though no actual cash ever left the company's bank account. It's kind of weird, but it's a loss that's literally caused by being successful.
And this slide just lays it out perfectly. On the left, you've got that scary headline number. But on the right, once you strip out that non-cash paper loss, you get the adjusted net loss, $251 million. Now, don't get me wrong, that's still a lot of money to burn. But it tells a completely different, much more manageable story than losing almost $2 billion. This is the real number that serious analysts are looking at.
Okay, so now that we've cleared up that whole loss situation, let's get to the good stuff. We're going to look at the key metrics that are actually driving the excitement around MiniMax. This is where you can really see the growth story taking shape. Now, this is where it gets really interesting. Check this out. For the entire 2025 fiscal year, MiniMax made $79 million. But by February of 2026, just a month into the next fiscal year, their annual recurring revenue, or ARR, was already over $150 million. ARR is basically a snapshot that says, if things continue as they are, this is what we'll make in the next 12 months. So their current pace is already double what they made in all of last year. That, my friends, is what we call exponential growth.
And it's not just that they're making more money, they're making money more efficiently. Their gross margin grew by a massive 437%. It jumped from about 12% to over 25% in a single year. This shows that as the company gets bigger, it's actually getting healthier with a real path to making a profit. So how are they pulling that off?
Well, a huge part of the answer is just getting smarter with their tech. The cost of actually running their AI models, what the industry calls inference cost, they managed to cut that by more than half in just a couple of months. For any AI company, computing power is their single biggest cost, so slashing that expense is absolutely critical for surviving long term. Investors watch this metric like a hawk.
Okay, so the core numbers are looking strong, but what's their big picture plan? This is where MiniMax is doing something totally different from its competitors. It's building its defensive moat, but it's building it overseas.
Just look at this breakdown. Nearly 3/4, 73% of the revenue comes from outside of their home market. For a Chinese AI company, that is almost unheard of. Most of them focus on the giant market at home first, but MiniMax, right from the very beginning, decided to go global. It's not just a side project, it's their entire strategy, and it really sets them apart. But going global first is a massive gamble. The upside is obvious, right? You get access to a way bigger market, and you get to sidestep the brutal price wars happening back home. But the risks are just as big. It costs a lot more to win customers in all these different countries, it's a huge challenge to make your products feel local, and you're going toe-to-toe with giants like Google and Microsoft on their home turf. It's a really, really bold play. So this all leads us to the company's price tag, its valuation. To really get why MiniMax is valued so highly, we have to look past the company itself and look at the stock market where it's listed.
And here's the key: scarcity. It's that simple. If you're a big-time investor and you want to put your money into a pure AI foundational model company on the Hong Kong Stock Exchange, you have two choices. Just two. And MiniMax is one of them. That simple fact creates this huge demand for a very limited supply of stock in one of the hottest sectors on the planet.
This quote just nails it. A big piece of MiniMax's sky-high valuation isn't just about its future growth, it's about its unique position as a rare find. When the supply is that low and demand is that high, prices tend to go up, sometimes way beyond what the basic numbers would suggest.
All right, we've pulled apart the accounting, we've looked at the growth, we've analyzed the strategy, and we've understood the market dynamics. Now it's time to bring it all home and lay out the final verdict for anyone thinking about investing.
So here's how it all stacks up. The bull case, the reason to be excited, is powerful. You've got that exponential growth, margins that are getting better super fast, a unique global strategy, and that scarcity factor. But the bear case, the reason to be cautious, is just as strong. The valuation with a price-to-sales ratio around 380 is, well, it's astronomical. To put that in perspective, a really good, fast-growing software company might trade at 20 or 30 times sales. This is a whole different level. Plus, they face brutal competition, and there's a huge risk they just can't pull it off. They're basically priced for perfection.
And that brings us right back to where we started. MiniMax is a story of incredible potential, balanced against enormous risk. The numbers show a powerful growth engine is already firing, but the road ahead is incredibly difficult. So the real question for investors isn't just about the numbers today, it's whether you're willing to pay a historic price for a shot at owning what could be one of the few big winners in the AI wars. For now, only time will tell.